everyone, right now is April 20th, 2019, Saturday, around 11:10 p.m. here in New York City. So in this video, we're going to be analyzing three instruments. SPY, that's the S&P 500 ETF. Also, we're going to analyze gold prices using gold futures. And finally, we'll be looking at crude oil price using crude oil futures. Okay, let's get right into it. So first up, we're going to be looking at S&P 500 via SPY. So right now, this Pendragon 321 system, by now you guys should be familiar with it. It consists of three charts. Daily chart is all the way on the left. And in the middle is the weekly chart, and on the right is your monthly chart. So 321 consists of three lines, two sets of trading signals, and one indicator. So let's look at the daily chart first. So last week, it was a short trading week because Friday was Good Friday, so the market was not open. If you look at the charts on daily chart, let me blow this up. So right now we're looking at daily chart. Let me expand this chart. If you look at 1, 2, 3, 4, basically we have 4 candles for the last week, and they look kind of quite interesting, a little bit turbulent. If you look at it, the market went up to this is Wednesday, okay, went to the high, and on the same day you had this huge red candle, so it dropped quite a bit. And then on Thursday it opened around this level, it went down, it come up, and all this and that. So it's quite a lot of quite some drama for last week, just for only 4 trading days. So what's really going on here? Let's take a look at it. So last Thursday the market closed at 290.02. all right, that was the closing price for the week. And if you look at this green candle right here, that was actually April 12th, or 2 Fridays ago. The close that day, it closed at 290.16. 290.16. So the previous Friday before last week, it closed at 290.16. And last Thursday, because Friday, we didn't have any trading session, it closed at 290.02. That's a difference of 0.14. Okay, let me repeat that again. If you examine these two numbers, that's a difference of it's 0.014. All right. So after all this hula, after this drama, at the end of the day, and notice that it's actually rather interesting, it closed slightly above the 290 level. That's what we call pinning the price, for option expiration. So a lot of time market makers, when the markets are quiet, when there's not much going on, sometimes the market makers or options, these option makers, option market makers and option markets, they try to pin the price to a certain strike price as to maximize their profit. And if you notice that, also, furthermore, like I say, there were actually last week quite some turbulence, even a couple of days, the day before the expiration. So temporarily, the premium was kind of quite high, artificially inflated a little bit. Okay, but at the end of the day, when option expired last Thursday, all right, they pinned the price at 290.02. So that was what's going on. So after all that, basically was not much change for the whole entire week. So now the option expiration is over now. What's going to happen next? April is one of those months that has a lot of earning reports. So what's going to happen is that between now until the end of the month, quite a few companies, they're going to be reported earnings. So those could have price move consequence. And for what's going to happen, most likely course for the upcoming days, let's go back to monthly chart. If you look at monthly chart, let me expand this chart. Okay, let's bring it back up here. First thing you want to pay attention to is that, as we've been mentioning this for the last few videos, it's getting very close to the old high, which was at 293.94. So let's draw a line over here. 293.94. That was the old market high. 94. I'm sorry. Here we go. 293.94. If the market can break above that price, then we're gonna have a new all-time high on the S&P. Okay. So what's the most likely scenario here? Well, It seems that for the past few weeks, ever since the market been recovering quite strongly since the end of last year, right? Everybody look at these last few month action. It's been gunning for this old high ever since. It's like a classic V-shaped recovery. This is actually a beautiful V right here. Everybody look at it. And in many respects, this is kind of like a foregone conclusion already because we are really not that far away from it. It closed at 290.02. The old high was 293.94. That's not even, that's barely a 4-point away. That's about equivalent about 40 S&P points, give or take. All right. So we can easily do that in a matter of days or even a single day if the market's really strong. And definitely before the end of the month, before the end of April, we can probably do that. So here are some likely scenario. Number one. Oops, let's see. Okay. Broke all high, then retrace. Okay, that's possibility number one. Right now, based on my experience and just my intuition, okay, so this is not scientific by any means. It's not like I have quantified this or any better analysis. Just it's a gut feeling. Let's put it, mostly gut feeling or based on experience. I'm giving it like a 60% chance for this to happen. So most likely you'll break through the old high and then retrace. Okay. And scenario number two. Okay. Broke old high and no retracement. All right. I am putting that. I'm giving it 10%. So basically, what number two is saying is that the market just gonna keep on going. Okay, like that, keep on going, going up, and it's not gonna stop for anything. All right, the chance of that happening right now, honestly, I'm giving it 10%. Because the market is being, by many measures, it's kind of getting slightly ahead of itself anyway. Now, number three, okay, could not break above O high, and we just retrace from here. Retracement starts now, so let's give it about a 30% chance. Okay, let's go back, examine this a little bit more in detail. Now, if you are looking to get shorted in this market, that means you haven't that means you're not in the market yet, okay? But you are looking for opportunity to get shorted in this market. What would you do right now? Okay. Well, actually, you know what? Let's retrace back slightly first. If you're a bull, okay, you're looking for the market to make it higher high, and you're very bullish and optimistic about this market. Your job is obviously try to push the market higher and higher, right? You're just gonna buy. All right. So that's okay. Let's get that out of the way. So you're gonna push the market higher. Now, so that's back to what I was saying before. If right now you are a bear looking to short the market, but you haven't, okay, or you were a bear, but because the market's been going up a lot, you already either have to take a loss or trim your position, but you're looking to reload and get back in. What would you do? You look at a chart like this. As a bear, of course, you want to short as higher price as possible because that gives you more room to drop, right? So if that's the case, you see this, the market's being strong, the chart gunning for the old high. You'll probably just let it happen, step back, let it happen. Okay? So in this sense, both of the bears and the partial, someone looking to go short, the possible bears, they're looking for the market. They're gonna step away, let the market go higher, or step in if you're both case. Okay? And also there's another concept called gunning for stops. Because if you are shorter, the logic goes, you'll probably place your stop slightly above the old high. Okay, a lot of times the market makers or a lot of people, market players, they'll purposely take the market above the old high, try to flush out all these people who place the stop loss order above that, and then the market allowed to drop. That could be, but honestly, at this point, this concept's been known for a while already, and I'm not sure other than the most beginners or how many people will actually really fall into that trap. Okay, you might take the market higher. So the most likely scenario right now is that's why I'm giving it over, about over 50% chance, at 60% chance. The market will probably indeed make a new breakthrough the old high. Okay, then we retrace from there. But why I give 30% chance to, if the market, the market cannot break an old high and it just go down. So it looks maybe like I don't know what you want to call it, double bottom, triple top or double top, what have you. Okay, why is still kind of, what I say, about almost 1/3 chance? Because if everybody's expecting something to happen in the markets, there's a good chance that it may not happen. Okay, so as a trader, our primary function is not even so much to predict the markets as to prepare for every possible outcome. So by me putting on a 30% chance, it's much higher than the 10%, right? The number 2 option. It's my way of saying that we gotta definitely come up with a proposal if this indeed happen. Okay, and how are we going to react? How are we going to take advantage of this situation when this scenario does happen? When this very unlikely scenario does happen? Well, that's why you had these 3 lines, the Pendragon 3 lines. That's how they come in handy. So we already know if the market goes up, basically if you're long, we just cap at it, and we can look to go shorter once the market above the high. Break through the high, and if it does retrace, that's options number 1. Okay, so we know that. But if right now that doesn't happen, it's number 3 happen, what are we gonna do? You examine from your daily chart and your weekly chart. If it started going down, you already have all these prices to help you. They could be your first possible price target for your short positions. Everybody see all these price? Okay, or if you are a long-term bull, okay, these prices could be your additional adding level, pyramiding level, adding onto your position. Okay, so now this way we are all prepared for all possibilities, and that's the best way you can be in terms of markets. So now let's go on to look at the gold price. So right now we're looking at gold futures, and let me make the number clear. So first thing I want you to draw you guys' attention to is look at the daily chart on gold. And a quick review. Pendragon 321. 3 stands for 3 price lines. That's your green, pink, and purple line right here. 2 stands for 2 sets of trading system. I have one of them called Trend GPS. Every time you see this pink dot happening, that's a confirmed short signal. Okay, again, the pink dot, like in these boxes, that's a confirmed short signal. When you see a pink cross, that's only an indicator of a downtrend has started it. Right away, of course, you have a pink dot very close to it. Okay, so pink cross, again, that's a confirmed short trend. That's not a signal, just indicating the trend has started. For confirmed short signal, you have to look at the pink dots. So far on gold, if you guys look at this, and of course, the blue dots is your confirmed long signal. They've been working out quite well. The blue dots tell you where to get long on gold, and the pink dots tell you where to get short on gold. So this is on the daily chart. So far, over a week ago, we had this confirmed short signal on gold, and indeed that's where the price is going down. Okay, so now what next? So let's go back to our multiple time frame analysis. Let's go back to our daily chart, weekly chart, and for gold price. On the other videos, if you guys recall, I mentioned every time when you look at this analysis with these three lines, first thing you gotta do, as far as 3 lines are concerned, is to determine whether the current trading price is above or below all three lines, all 3 Pendragon price lines. If the current market price is above all 3 price lines, then there's good possibility, or it's a strong possibility, that a strong up move can take place from there. That's not a guarantee. It's just that every time if you examine, a strong up move usually occur when the price is above the 3 price lines. Because why? There's no more resistance above the price now. If if the current trading price is below the 3 lines, then it's likely that we can drop below it. Okay, so right now, if you look at gold right here on a daily time frame, the current trading price, is it above or below all 3 price lines? It's below. All right, so that's on a daily time frame. Now go to the weekly chart. Is it above or below? Again, it's below. So at least on 2 out of 3 time frames here, we have a possibility of down move happening, major down move happening. Now on the monthly chart, Okay, there's another interesting thing now. Everybody see how a few months ago we have another confirmed short signal. That's why the gold price, this monthly signal, the short signal from the monthly chart, it confers with the short signal from the daily chart, right? Only thing that's interesting right now is that on the monthly chart, however, okay, it's not touching the try to challenge this green support right here, which is 1275.71. And the close price for last week for gold futures was at 1276. Okay, the only difference by 0.29, 0.29, not even $1, not even 50 cents. Okay, the close price for last week for gold futures. Everybody see that? I label it right here, 1276.00. And the price line, the green one, is 1275.71. So now here's the scenario now. If gold can, if this support does not hold, okay, does not hold, and it broke, it's possible a new run of sharp drop can happen for gold, just like it happened right here. In the, I guess that's from spring to summer of last year. All right. Everybody see that? Because it's below the 03 lines. So if right now there's 1275.71. Let's say 1275 give or take around there. If this support does not hold, it could be a new round of a sharp drop for gold. So that's what you want to look for. If it does hold, however, we have all this price on top. It could be a trading range for a while. Okay, based on this possible resistance over here. So that's the analysis for gold. Now, finally, let's look at crude oil. Again, we're looking at crude oil futures. So let me make the lines, the numbers more clear to read. Break up the numbers here on the weekly chart in crude oil. So every time when I have to do that, break up the numbers, that tells you something. Because why do I need to break them out? Because they're too close to each other. So indeed, if you look at it, these three prices are fairly close on the weekly chart. The high end is 60.39, middle one is 59.69, and the bottom one is 59.37. So what that's telling me right now is, again, just like gold over there, or any product we can do. First of all, is the current trading price above or below the three lines? Obviously, on the daily chart, above three lines. On the weekly chart, above three lines. And on the weekly chart, those three numbers are fairly close. So what is that telling me? The price from 60.39, and if you look at right here on the monthly chart, 60.49. See how close now we have 4 sets of number. You can even argue on the daily chart 61.03. So that's it from 61 all the way down to 59.37. This is $2 level-ish. It's a very strong potential support for crude oil. Okay, so mark that down. This price level is a potential very strong support for crude oil because too many price converge around here. So again, that's the advantage of using these Pendragon 321 system, because we don't have 9 sets of separate numbers. We don't, because if you look at how 1, 2, 3, 4, 5, these 5 numbers really converge into 1. So we really have 1, 2, 3, 4, 5. 5 sets of important numbers to look out for on 3 different time frames. And you see how even though they are different data, different time frames, they will come to the similar conclusion. And again, I want to emphasize, every time when I punch out this chart, you guys see me just type out the symbol. Okay? You don't see me try to type in different parameters for these indicators. I'm not optimizing these things in any sense of, in any sense of the word. Okay? It's the same set of parameters used up through different time frame and different products. That is the rigor, and the robustness and the power of these indicators. Okay, these power lines. Now, another thing we got to pay attention to is that we do see a pink confirmed short signal on crude oil. Now, this is a rather weak short signal. Why is that? Because you see that it's a number 3 series, and it's followed by a higher high. Every time when you shorted something, you want to see a lower high. So when that happens, Okay, when it's making a higher high and it's giving you a short signal, you can pretty much ignore it or don't give it too much credence to it because it's not behaving the way that any short trend, downtrend should be behaving. Okay, but nevertheless, we gotta pay a little bit attention. So what's going on here? So we established the fact on the daily chart, on the weekly chart, the current trading price is above the 3 lines. So that means a possible strong up run, for crude oil could take place from here. So now let's examine the monthly chart. Okay. Lo and behold, why is the crude oil being on such a strong up tear, right here? A few months ago, we have on the monthly chart confirmed long signal on crude oil. Everybody see it right here? Okay. Now on the monthly chart, it's not above 3 lines. It's actually between the 2 price line, between the pink one and the purple one. So on the longest time frame on the monthly here, our potential resistance is going to be 73.89 or 74-ish level. Right? So it looks like on a long-term basis, you might want to go up gun for this target. But on the short term, there's a possibility that the market can pull back. And if you pull back, I already give you the price level below. So basically, we have this wave action. Okay, so if you examine the monthly chart and the weekly chart, now you can actually picture or construct this wave-like motion, price motion in your head now. So you might go up, then you might go down, right? You might touch the support right here on the weekly chart, and you might go up again. So as we all know, price rarely goes straight up. They usually go the zigzag wave motion. So with this Pendragon 321, you can construct a nice wave pattern for the price actions, and these are based on different time frames. So furthermore, it's like an X-ray. We are looking at this from a different time perspective, from different time frames perspective, and we synthesize them together, looking at them as an integral picture. So we can see where each impetus for different price move are coming from, different impulse wave in some technical analysis, their theory. Okay, so that's what we have here. So let's conclude this week's presentation. And if you like to any comments, suggestions, you can either leave comments in this YouTube channel or you can email me. My email address is panlong321@outlook.com. All right, take care. And always trade with passion and discipline. I will see you guys next time. Take care. Bye-bye.